In this video, we'll talk about several aspects of the bonds. Here we have Shiloh Cove. They've issued $200,000. This is the face value of 5-year 9% bonds. The 9% tells us this is how much interest is going to be paid on these bonds. They issued them on January 1st, 2025. Interest is payable semi-annually. This is twice a year, on June 30th and then again December 31st. The market rate at the time of issuance is 10%. Shiloh uses the effective interest method to amortize discounts and premiums. And then we have a A through E, several different items that we need to work through and answer the questions to. First, we calculate the issue price of the bonds. So to do that, and I have A here over on the left, first we have to calculate the amount of the interest payment. Actual interest payment will be $200,000, and you can do this two different ways. $200,000 times 9% times 6/12. So that would be half of the year. Or you can take that 9% and divide it in half. It's half of the 9% because a payment is being made every 6 months. So again, you could do it either way. I've added the other formula for you there, so if you want to use the full 9%, it works the same way. You end up with $9,000. That would be the amount of interest that is going to be paid every 6 months to the people who have invested in this loan. So we need to go to our present value tables, the present value of a single amount, which we say that's the present value of $1 or present value of 1. And then we also need to go look at the present value of an annuity. That's going to be for the multiple payments, which are your interest payments. So now, because we're using the effective interest rate, we need to consider the market rate. So the market rate at the time these bonds are issued is 10%. So we'll look at our number of periods. This is a 5-year bond. It's going to make payments. It's going to pay interest twice a year. So our N is going to be 10. 10 is, again, the 5 years times 2 payments per year. So N is 10. And then we need our market rate. So our market rate is based on the market rate that's quoted, 10%. So the 10% is being paid twice a year. So we're going to divide 5%. So go to your table. First, let's do the annuity table. Go to your present value of an annuity, which is the factor you will need to use for your interest payments. That's the second item you see here. Let me bold it for you. So present value of an annuity, $9,000, the amount of the interest payment times, and this is the factor you would have gotten out of your table, 7.72173. Multiply that across. The present value of those interest payments is $69,496. Now we need to go to our present value of a single value, present value of 1 or present value of $1 table. So go look at this table. The same N and the same I. N is your number of periods. It is 10. Market rate per period is your interest rate. So interest, or I, is 5%. When you go to that table, you should find this factor of 0.61391. Multiply that times the $200,000. The $200,000 is the amount of the bond that is going to have to be paid back at the end of this 5 years. So when you calculate that across, you multiply across, you get a total of $122,782. You need to add the present value of the bond plus the present value of those interest payments together. And when you do, you get the price of the bond. The bond should be issued then or sold for $192,278. So remember now, this is a $200,000 bond. It is going to be issued for less than $200,000. So what we have is a discount on the bond because it is being issued at an amount less than the face amount. The difference between the two numbers, $7,722. Now let's look at the B portion. So the B portion asks us to journalize the issuance of the bond. Remember, our calculation showed that the bond should be issued or sold for the $192,278. So the amount of cash received is that $192,278. The bond payable will always go on. The records always be recorded at the full $200,000, the face amount of the bond, and then we need to plug what the difference is. So in this case, we already know this is less than the face amount, so this is going to be a discount on the bond payable. A discount needs to be recorded over on the debit side of the journal entry. So all of this works out just like we expect it to, and the difference is the amount that we had calculated to be $7,722. Letter C asked us to prepare an amortization table showing the first 2 interest payments. I've set this table up so that we can go through the first 2 years, which would be the first 4 payments, just so you can get a good feel and understanding of how the numbers would work. So we have our carrying value. This is $200,000, the face amount, minus that amount that is the bond was discounted on the front side. If you added the two together, you would get $200,000. So the first payment is made on June 30th of $9,000. So interest expense would be the carrying value, and we're multiplying it times half of the market rate. The market rate is 10%, and so it would be half of that. So you can say times 10% times 6/12, or you can just say times 5%. You'll get the same number. Now, some of this, you notice your interest expense is more than the interest payment. That's because we've got to recognize some portion of that discount each period also. So what we want to do is take the amount of interest expense, and we're going to subtract the amount of the interest payment, and we get $614 that will be applied to the unamortized discount. So then we'll take the previous balance, which was $7,722, subtract off that amount that's being advertised for this period, and it's going to be reducing that number. So notice it ultimately is going to 0 at the end. You'll see that this number is going down as we go along. The carrying value is going to be increasing along the way. So we start with our $200,000, I'll say equals 200, subtract the amount that is right here and still hasn't been amortized. The carrying value is the $200,000, subtracting this new balance in column D. You will see here I've got your A, B, C, D, and the relationship underneath them too, so you can work with that if you need to. Then December, we're ready to make another payment. So this payment is made of $9,000. We want to calculate interest expense based on the carrying value, so I'm going back and picking up the new carrying value there in column E, and I'm going to multiply it times the market rate of 10%, and then times 6 divided by 12, which represents half a year. We'll just go ahead and do that again. Discount amortization is going to be equal to that full amount of interest expense minus the amount of payment, $9,000, so $645 will be applied to the discount amortization to get a new balance, minus what's in the cell, and Excel took care of that for us. So notice this amount is going up each time there is a payment made. Let's do it 2 more times and then we'll be finished. So carrying value, now I'm going to just take the shortcut. 10% divided by 2 is basically 5%, so I'm just going to take that shortcut now. The amount of amortization for this period is the total interest expense minus the payment, or $677. Amortized discount minus the new amount that's going to be applied is going to be put in there, $200,000, minus the amount in unamortized discount, $194,213, one more payment. So let's say the carrying value times, again, I'm just going to use 0.05, and then the amount that we're going to amortize, the full interest expense, and subtract the payment, and you get $711 to be applied to the amortization. So we'll say this amortization minus that amount, $711, gives us $5,076 left. minus the amount in the first 2 years, a total of 4 payments. And you will notice that the discount has to be amortized away each period. Ultimately, it will have a zero balance. Notice that the amount of discount being amortized each period then is going up. The carrying value is the $200,000 minus the unamortized discount. Ultimately, it is going to be $200,000. If we went through all 5 years and put these other payments in, this is what we would have. The question asked us, or the problem asked us to just do these first 2 parts, the first 2 payments. So that would be the answer to letter C. Letter D asked us to journalize the interest payment for December 31st, 2025. So because we have our trustee table prepared here now, we have everything that we need, all of our numbers in the right place. So all we have to do is make that entry. So the date, 12/31/2025, interest expense, I'm picking it up right there out of the table, $9,645. The amount of discount to be amortized for this period, with a credit to the account, is $645, and the amount of the check payment that is going to be sent out for the interest on the note is $9,000. And now letter E. Prepare the interest payment journal entry for 12/31/1225 using the straight line amortization method. So remember when we calculated the total discount for this bond up at the top right hand side, the total amount was $7,722. There is going to be 10 total payments, 5 years, twice per year. So we can take that amount, divide it by the 10 payments, and that means we'll be allocating $772 each payment period. So every 6 months when an interest payment is sent, this amount of $772 will be added on to the interest expense, and it will be applied to the discount on the bond payable. So in this case, the cash payment is still going to be $9,000. Discount on the bond payable, $772. And then the interest expense, we will plug that number. It would be the combined total of the cash amount and the discount amount. And again, it would be the same exact entry for 10 times because we have 5 years, twice a year, so 10 total.